Thanks to Delupa for sponsoring this season of Compounders. Delupa scales the velocity of an investment team's idea generation by allowing analysts to spend less time locating and manually inputting meaningful disclosures into Excel. As someone who spends a lot of time updating models with data that some of the other major platforms, such as Bloomberg and Capital IQ, don't capture, I have seen firsthand how much time Delupa can save professional investors. Specifically, Delupa captures data from all company reported sources, including from footnotes, MD&As, and investor presentations. Their data sheets also include GAAP to non-GAAP adjustments, guidance, and all company-specific KPIs. Each data point is auditable to the source for easy verification and accuracy. Delupa's Excel plugin can also update existing models for the latest quarter in just a single click. More bulge bracket banks and top-tier investment managers are trusting Delupa for assistance in initiating coverage, building and maintaining industry dashboards, and keeping models up to date. Please visit www.delupa.com/compounders to learn more about how Delupa can help increase your team's speed to differentiated insight. Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Evan Curtis, the Executive Director of Investments at Vanamor, a private real estate investment firm. Given the ongoing turmoil in the real estate market, first caused by COVID and then exacerbated by the sharp rise in interest rates, I was excited to have Evan on as our first real estate-focused private investor. In this wide-ranging conversation, we discussed the history of Vanamor, including the real estate verticals it has chosen to focus on, what Evan has learned about investing through real estate cycles, the opportunity set in investing in commercial real estate right now, how Vanamor incorporates data and technology within its process, and the benefits of running a small, nimble investment firm. And without any further ado, here's my conversation with Evan Curtis of Vanamor Investments. Evan, I'd love to hear the origin story of Vanamor and how you got involved there.
Thanks, Ben. Yeah, happy to give some color. So Vanamor's been around since 2017. And the founder, his name is Bobby Larson. He's got a long track record kind of in the multifamily value add space, which is where Vanamor focuses. And I guess my origin story with Vanamor is I worked at PIMCO, Pacific Investment Management Company, for about 12 years, and I overlapped there with Bobby Larson when he worked at PIMCO as well. So we got to know each other a little bit then. Kind of went off our separate ways. He went to business school, then went to a large value add multifamily shop for a number of years before kind of starting at Vanamor. And I kind of went off and was at PIMCO for a number of years, and then another residential real estate company for about 5 years before we kind of ultimately reconnected and said, look, I think it's an interesting time in the market. Vanamor, I know, is looking to grow its portfolio. So let's see if we can really kind of build a diversified, strong portfolio that can provide kind of the returns and expectations that we hope it can.
And what was the opportunity in 2017 that Bobby saw? I mean, it's got to be totally different than the world today. What was he looking to build then that, whatever spurred him on to create this vehicle?
Sure. So the company that he was working for is called MG Properties. They're a fairly large player, again, in this value add multifamily space, and they had a pretty interesting and scalable and sizable model that they were using that was growing to a size that they were looking at institutional sized assets. And Bobby was seeing opportunity there, as well as assets that were a little bit lower in purchase price, and thought that there would be opportunity to execute a similar model on kind of the middle market space where we're focused on, which we define as between 5 million and 50 million in purchase price. So kind of taking some of the ideas from a very successful model that he helped implement and grow at MG Properties, and working on something separately on his own.
In the institutional world versus kind of the middle market world, right? Like, I guess institutionals maybe like $100 million plus in purchase price. I'm just throwing numbers out there. Maybe you can correct me if that's wrong, but like, is the thesis that there's more inefficiency as you go further and further down the purchase price, right? Like, whatever, like a trophy office building, anybody can come in or a trophy multifam, anyone can come in and look at, but smaller value add lease up situations, just scrappier, maybe more inefficiently priced. Is that, maybe talk to me a little bit about how that works as you go up and down the size of the of the equity check you have to write.
Yeah, I would say 30 million plus, you can kind of get the institutions looking at deals at that size. The a lot of what you're saying is definitely true. You get kind of into the smaller deals. A lot of times you have an asset that's been owned by for a number of years by a mom and pop type of owner who, they have a really low basis. They've held it for 10 plus years. They don't really need to execute a value add strategy. They've kind of ridden up the beta wave over the years, and they're happy exiting at a price that is very attractive from their perspective. And from our perspective, it's also an opportunity and a story that we like, where you've had one owner for a number of years. The units haven't been updated in maybe 10 plus years, so you have a good opportunity to kind of execute that, where I think that's a little bit more prevalent on the smaller deals than the institutionally owned and managed assets in the 30 million plus side. You certainly still see it though, on those larger deals, but I think it's a little less frequent, and there's definitely just, well, more inefficiencies usually kind of in the way that properties are run at that lower size, be it on the property management side or kind of on the leasing strategy, or just on kind of keeping up with market rents. So generally, again, you see more opportunity in the middle market, and less competition as well. So you're competing against other folks who are sophisticated, but that have a lot less kind of support and experience in a lot of cases in the market. So I think that's also one of the things that we like about our small Vanamor team is all of us come from kind of an institutional background, where we're competing with folks in a space that we feel comfortable about with our kind of experience and ability to execute.
I'm curious about how the firm is structured. Do you have a fund? Do you invest via your balance sheet? Tell us a little bit about how you put capital to work.
Sure. So we use a syndication model, and have historically. So that's one where you have a GP LP structure, and we're the general partner, and we have a group of investors that ultimately come and invest alongside of us. And we do that on an asset by asset basis. So we have an equity stake in every deal that we acquire. But we don't have a fund where it's kind of a blind pool fund where we're allocating to a specific raise that we've already executed. In the future, I think we ideally have kind of both structures. There's definitely pros and cons about the single asset piece and the fund structure, which happy to go into if it makes sense. But right now we're operating on the single asset syndication model.
And after working at PIMCO for a long time, what attracted you to do something more entrepreneurial, and join Bobby at Vanamor?
I've always kind of done real estate on the side of my day job over the years, at a small scale, I guess, and have always enjoyed that and had kind of the entrepreneurial bug to ultimately do something at a larger scale. So it was a combination of a number of things. It was potentially joining the right team, which I think Vanamor is the right team and the right vehicle. It was also, you need personal timing to line up. You need market timing, which is one of the most important ones, I think, in my mind, to line up. So yeah, I had been kind of contemplating, could I go off and do something smaller or join a small shop for a number of years, but was at a point in the market where I was like, man, things are really, really hot and aggressive as far as pricing and valuations, and don't necessarily think that it's the right time. But I joined Vanamor early 2023, and we had the Fed kind of pivot at that point to aggressively raising rates in mid 2022, and there was considerable impacts to valuations that we were starting to see, and a lot of other kind of um, pieces were lining up to, in my mind and in our mind, what was going to make for a kind of a target rich opportunity going forward. The timing is always tricky on it, though. I thought 2023 would bring a little bit more kind of transaction volume and maybe stressed or distressed sellers, but there really hasn't been a whole lot. I mean, transaction volume is down to the tune of 70% year over year. There's been a very wide bid ask gap between pricing that sellers want to sell at and where buyers are willing to buy at. And you had the aggressive run up in interest rates, but you don't have sellers adjusting that quickly to the move in cap rates. So we've seen cap rates kind of sliding higher over the year, but a lot of people are still seeing that 2022, late 2021 valuation where they could have potentially sold at peak pricing. And, now they're seeing a substantial discount to that, and they don't necessarily want to sell, and buyers aren't willing to buy anywhere near those prices at this point as well. So it's a very interesting market from our perspective, from an opportunity going forward.
And you've been involved with several different areas within commercial real estate. I'm interested in how Vanamor settled specifically on what you call the multifamily value add, which we'll get into what that means. But in terms of why multifam, why is this an interesting space within whatever all the different verticals within commercial real estate you could play in?
Yeah, I think multifamily makes sense for a lot of reasons. One is that really like kind of the ability to provide a product to someone that can ultimately improve their lives, and has a incentive alignment component to that as well. So we are executing, again, a value add strategy, which is a lot of times is improving the interior and the exterior of the unit, and kind of making things run efficiently at a property. And the tenant sees it a little bit differently, but somewhat the same. They want to live somewhere that feels safe, feels nice, and that's something that we can do, which also keeps them kind of in a place where they're open and willing to stay in the unit for longer because they like where they live, and that flows down to the bottom line. It reduces turnover expense, which is one of the very costly expenses if you have people moving out every 12 months. So you can have longer retention, which ultimately improves your bottom line. So that's definitely one piece that I really like about the multifamily space. There's a couple other areas as well. I think it's lower on when you think about the different commercial real estate assets: office, industrial, self-storage, retail. I think it's lower on the spectrum of assets that could face a systemic or kind of functional obsolescence risk. So office is the prime example. Nobody really saw what happened to office coming, which has really kind of slashed valuations by north of 50% in a lot of cases at this point. Multifamily is not likely to be in a situation like that, even though it's hard to know what you don't know. But I think that's something that draws me to it, as well as right now there's a huge affordability gap between home ownership and renting. That's the largest gap that we've ever seen, and while that gap could narrow, I think where it is now is a very good kind of demand driver on a go forward basis, that you're going to have a lot of folks that are just unfortunately priced out of home ownership and will need to live in apartment or multifamily asset. So that's another reason. And then lastly, why I like the asset class and kind of settled on it is it's also got good capital market support. So, unlike the other assets that we discussed, so on the debt side, there's Fannie Mae and Freddie Mac, the agencies provide lending to multifamily, and this has been even more pronounced with what has happened since the Fed started raising rates. Was you've seen banks really pull back. You've seen bridge lenders or debt funds really pull back. But the agencies are still in the market and lending, and they are kind of the most attractive option at this point. And they're likely going to be there regardless of what type of economic situation you're in. You get a little bit of kind of credit pullback from them as well, certainly, but you don't see them just say, "Hey, we're pencils down, we're not lending" at this point in time. So, liquidity in the market, I think, is strong, and another reason why I like the space.
This season of Compounders is sponsored by Dalupa. Dalupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Dalupa offers an AI-driven single source for all company reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit dalupa.com/compounders. And in your response, you mentioned the idea of like not looking at multifamily as a place where you're not going to see a whole lot of distress because of the lack of not as much risk of obsolescence. Would I be right in assessing your philosophy as investors as kind of like quality at a reasonable price versus looking for things that are distressed in some way?
I would say somewhat true. We on the value add side, it's a pretty broad way to categorize somebody as a value add strategy, I think, at least. So, the distressed assets, you could be purchasing something that has 50% vacancy and you have to take it down to the studs. That's value add, opportunistic type of deal. Where we are is more on, I like to describe it as the lighter value add side. So, one, we're targeting assets that are a little bit newer in vintage or construction. So we like properties that are built in the mid 80s or newer, that have somewhere between, call it $5,000 and $15,000 per door of capital expenditure that we use in our budget. So it's not stuff that we're looking to take down to the studs and rebuild and capture a $500-$700 rent premium. There's inherently less risk in that type of business plan, which we like. We shy away from the 60s and 70s and older product that has different systems, electrical and plumbing that can be very big ticket capital expenditure items, but you don't necessarily get the same return on investment from that. But it can blow up your budget real quickly as well. So that's another piece of, if the compensation kind of factor makes sense, we would look at that type of deal, but the spread between 60s and 70s versus the newer product just hasn't made sense to us much recently. Again, the strategy is to focus on well located assets that we think can provide a good combination of cash flow and capital appreciation over the long term. So focusing on assets with positive financial leverage is also something from the cash flow perspective, something that we really look for. So positive financial leverage, meaning our debt cost is lower than our cap rate going in, or at least neutral financial leverage. And that's been one of the biggest challenges, because you've seen interest rate and debt costs go up as much and as fast as it has, but you haven't seen cap rates move as quickly. So a good combination of cash flow and capital appreciation over long term is definitely part of our value add strategy.
And Vanamor has an existing portfolio of real estate assets. Can you give us a breakdown of what that looks like today in terms of regions? And I assume it's all multifam, but maybe correct me if I'm wrong there.
No, that's right, and it's pretty geographically diverse right now. So we have our current portfolio is roughly 100 million in valuation. It's spread out across the Pacific Northwest. We have an asset in California, Southern California, and we have one asset in Tampa, Florida as well. So, as far as kind of geographic focus that we have, it's, think of an L shape on the West Coast. So Pacific Northwest down to California and across to Texas, plus Florida. Um, so it's we're covering a lot of markets, which I think is a good thing right now, especially. You see, as we're kind of in this transitionary period of valuations moving off of peak pricing, like we mentioned earlier, you've seen certain markets move slower and be impacted by various factors. So, kind of being able to look at a number of different markets to get a sense of relative value, I think is important right now, and ultimately will help us kind of know where market pricing is, because on the private real estate side, you don't have um, liquidity and market pricing like you do in the public side. So really kind of keeping a finger on the pulse of where things are actually transacting and underwriting across a lot of different markets, I think is very helpful for our process.
And how did you decide on those markets? I mean, Pacific Northwest, not so much, but certainly California towards Texas and Florida, you got the kind of like the sun states in some ways. Like maybe talk a little bit about what you think about those markets and why you've chosen to put capital work there.
Yeah, we like the Sun Belt. California, we kind of, even though it's technically part of the Sun Belt, we kind of exclude it because it's a tricky market, even though we own an asset in San Diego there. But there's a number of hurdles from a regulatory perspective and just a difficult ownership perspective that I think makes California a little bit less likely that we're gonna acquire much over the next 12 to 18 months. But you've seen extremely strong population growth and job growth in the Sun Belt over the last 10 years. I mean, Texas is in Arizona, for example, are consistently at the top of population growth and job growth. You've been, there's been a steady flow of corporate relocations to those states as well, and just much more kind of business friendly legislation over there. So, we like markets that are in our mind going to kind of outperform over the long run, and we think that those Sun Belt states will continue to see um, higher than national average growth from a population and, again, job growth perspective. So, think that there will be great opportunity. I do think that there's a number of near-term headwinds that are coming to various markets, for very specific reasons, but over the long run, I think getting in at a very good basis at a well-located property, I think will ultimately pay dividends down the road.
And since you brought up the Sun Belt, might as well jump to the question I had on that. There, you and everybody else saw that job growth, population growth, right? And there was a fair amount of building of new multifamily projects, some of which are not even complete yet, from what I understand. And that there's a fair amount of supply that's going to be coming on in Sunbelt over the next few years. I mean, there's a lot of rent growth as well that was on top of that kind of precipitated all of that spending. So how do you think about the risks and opportunities in the Sunbelt, given that you guys weren't the only ones who had that insight about the attractiveness of those markets?
Yeah, great question. I think those reasons that you specifically said are why there are near-term challenges to these markets. Long term, I think nothing really changes on kind of some of the comments that I think we continue to see good population growth and job growth in those markets. But you saw a tremendous valuation increase in some of these markets, largely due to rent growth, like you said, that was happening there. And what that has done is those higher valuations spurred additional supply that has 18 to 24 plus month lead time. And so you're seeing a very large amount of incoming supply that is scheduled to come in 2024. I mean, it's the most supply that we've seen in about 20 years, and a lot of the markets coming to be delivered by the end of 2024. So, what that's done is it's put a lot of pressure on rent growth, where actually you have rent declines now. And I think that again is going to be a near-term hurdle. So it's absolutely had an impact on valuations, and that's where we get excited, which is we can potentially acquire assets that, if we can buy them right, hold them over a long-term period, will ultimately be holding a portfolio that is well positioned to again create cash flow plus long-term capital appreciation. So we look at it as we're positioned well right now to ultimately capitalize on some potential stress and distress that we're starting to see across other operators that maybe acquired a little bit too aggressively, or the market just kind of moved against them over the recent time period, and they may have to sell at prices they didn't think that they would have to.
And is the edge there the ability just to look out 7 years, as opposed to having to service your debt? Whoever owns it now has to service their debt and has short-term pressure, and interest rates are up, and it's just like you can look through the supply glut coming in 24 and 25 and say, in 2030, this is going to buy, like whatever, after 24, 25, it's going to be a really attractive market. And in 2030, this is going to be a really nice asset. That we could, either hold on to and flip. Like, it's just hard for me to think, like, in most of the real estate world, given that most buildings have leverage on them, that a lot of people have the ability to remain patient and look through 2 years of potential stress in acquiring an asset in one of those markets.
Yeah, it's a combination of the things that I think you mentioned. So it's one, our some of our principles at Vanamor are we like to be on the more conservative end of the way that we underwrite properties, and I think that has shown in the fact that our current portfolio is all still performing. So we have the portfolio that we spoke about earlier. We have no debt that's coming due anytime for the next 3 years and longer. So we're well positioned as far as kind of not being a stressed or distressed seller in the near term, which is not what everyone can say at this point in time. And we also, that is reflected in the fact that we underwrote conservatively the deals that we did acquire, and even though the market has moved against everybody, it's not just like our properties aren't feeling any pressure at all, but we underwrote them with kind of the conservative and realistic metrics that kind of allow us to continue to be performing in this current environment. And going forward, I think that you're going to see a good amount of operators that aren't able to now raise and deploy equity because they have had some challenges. They've had to make capital calls to their investors. There's likely going to be a decent amount of equity lost, in my opinion, as well from certain owners and operators and investors. So I think the longer term nature does make sense. We again are pretty selective in what we're acquiring. So the cash flow component, I think, is very understated in kind of the impact to the total return of an investment. But I'll just stop there.
Yeah. So getting back to the edge and an efficiency aspect, I think scale is an advantage in most businesses, but in real estate, if you have to put hundreds of dollars to work at a time. I mean, that really limits how opportunistic a firm can be. Maybe you can talk about the benefits of being able to write like a $5 million check and not have to write a $75 million check.
Yeah, it's a good point. I mean, when you get to the deploying hundreds and hundreds of millions of dollars of capital, you're largely a kind of a capital allocator at that point in time, and you're not really it's nearly as nimble and able to move again opportunistically on some of these smaller assets that are maybe from a non-institutionally owned seller. So I think one of the big benefits of being able to write these checks is just being able to pursue these deals that are sub-institutional, call it 5 to 15 million. And that really is the space I think where you had a lot of overly aggressive buyers as well. So, one, from a macro perspective, I like the space in general. Two, I think the timing of this space will show itself as more opportunity going forward. I mean, we talked a little bit on the last comment on kind of the hold period. One of the biggest things that has happened is a lot of people purchased with floating rate debt in 2020, 2021. And that debt, looks a lot different than the single family home debt where, you're typically buying a property with a 30-year fixed rate mortgage. On the commercial side, a lot of people used floating rate debt, which has a 3-year maturity point. So a lot of that debt is coming due, and when they put that debt on, it was SOFR was effectively zero. So the spread over SOFR on the debt cost was 300 to 400 basis points over SOFR. So their debt was somewhere in the 3 to 4% range, and now that debt is 8 to 9%, and the deals just don't work at that level. And there's been a huge increase in the amount of kind of operators in this single asset syndication space over the last few years that I think will be forced sellers.
And that gets to a question about the debt holders and what they do with, if they either have to, unload the debt or take the keys to these properties. There was an academic journal article that I read recently that said that that detailed all of the issues that banks might have because of their exposure to commercial real estate. How do you position yourself to establish relationships and be in the market to either, I don't know, you can comment on whether you'd purchase the debt as a way to own a property, or just as as something goes into, owned real estate at the bank, can you participate in taking assets away from the banks? Because, my sense is they certainly are not long-term owners of, $15 million multifam in Tampa.
Yeah. No, I think this is another part of where our institutional background benefits us amongst the competition in this space is we have kind of an understanding of how the capital markets process works particularly in a kind of stressed timeline like we're in right now. I guess first comment is the foreclosure process takes a really long time on this stuff. So that's one thing where I think, in 2023, again, maybe we were overly optimistic from when some of this bad debt ultimately rolls through and gets sold on the market. Because
like a year, 8 to 12 months. What is that?
Yeah, I mean, it can take 1 to 2 years sometimes. It's got to first, what's been happening right now. I think this is very interesting on kind of the timeline of things. Is first things that happen are the borrowers should be communicating with the lender and saying, hey, is there any way that we can do a modification, or we can do an extension of the maturity date? So conversations between borrower and debt holder are going on potential modifications, and that takes 2-3 months potentially. And then you have, are they going to do a modification or not? And if they're not going to, then the deal can go into special servicing, and then special servicing is trying to figure out how this thing is ultimately going to get worked out. And then you have, okay, do we need to sell it? And then they're doing BOVs, which is effectively an appraisal to say, okay, this is how much the property is potentially worth. Do we want to go through the sales process? And the general sales process on the commercial real estate side takes 90-ish days as well. So, you can easily get out to 12 months or even past 12 months on certain assets, depending on kind of the willingness of groups to come to a resolution that makes sense for everybody. But you've got this process where these things are happening right now, and where we are is we've been in this market for a while and have a lot of relationships with kind of the debt folks who originate deals, and we are talking to them on a weekly basis to say, hey, what are you seeing on your side? Where are the pain points? And I think we're not the only ones, but a lot of people are saying, we're looking to buy value add assets if there's a seller of something in our buy box that makes sense. So kind of having these relationships established and formed over the years puts you in a good position to be the be one of the chosen few who sees deals when those deals need to be offloaded for one reason or another.
And if I think about your footprint, one of the concerns I might have as an investor is that how do Tampa, Austin, Phoenix, Sacramento, Washington, like how do you know all of those markets really well with a small team, right? Like I just think of like a big REIT or something like that would have local density and local talent and local scale where you guys are more opportunistic. How do you mitigate the risk of, I don't know, being, kind of, for lack of a better word, like the dumb money entering a market where you don't quite understand the supply demand dynamics?
Yeah, no, it's a fair question, and it's a big geographic footprint, like you said, but we're not looking to like Texas, for example. We're covering the four major metros in Texas. We're not covering kind of Lubbock, Texas, and a lot of these places that are kind of completely on the outskirts of tertiary even. So, we're covering select major metros across the various markets that we're in. And we've been covering them for a while. So we haven't acquired a lot of assets in these specific markets, but like one of the things at my previous company on the value add multifamily side, very similar strategy to what we're executing at Vanamor. Like I was part of the team that we were buying assets in Dallas Fort Worth, and we had been doing that for the last 4 to 5 years. So um, we have been covering these markets for a long period of time, so they're not necessarily new to us. And once you have been covering them for a while, you establish relationships with the sales teams and with the debt teams and with kind of the local management and the various vendors in these markets. And it just takes time to really get up to speed and be able to sufficiently cover, like you're saying, a lot of different markets. But we also, again, we're acquiring assets that we think we could build a decent portfolio of. So we don't want to buy one asset in Phoenix, one asset in Pacific Northwest, one asset in Texas. Like we're going to get kind of clusters of assets in these kind of target locations that we want to acquire in. And that also helps from the property management perspective side as well.
Got it. And so there's this old adage that multifam assets trade at something like a 200 basis point premium to the 10-year. Obviously, when rates were zero, people were playing very low cap rates for high quality multifam assets. I think I've heard like Sunbelt was going like 3.5 caps, which is a crazy number to me, being coming from a real estate family. But I mean, now that the 10-year treasury is, around 4%, like how do you think broadly about the appropriate cap rates and spreads that you'd be willing to underwrite, especially given where you're seeing some potential supply coming online in these markets?
Yeah, there was a lot of markets where 3.5 cap rates were the norm. I mean, when your And the old adage is it's a decent kind of rule of thumb. The 10-year was at about 1%, right? And then so you were still 200 over, and you could get positive financial leverage even at these historically tight cap rates, which looking back is those are a lot of folks that are not feeling too great right now. But the way that we think about it is we do want to see a spread to treasuries and the risk-free rate. Treasuries, it looks like today the 10 years roughly three in the 380s right now, which is a big move down from where it was. And the volatility in treasury rates is a whole different story, but like it's cap rates move relatively slowly, but we've seen on kind of the public side on the rates, you can see a 50 basis point move in 3 days at this point. So we've seen treasuries move aggressively back down, and cap rates in a lot of the deals that we are kind of looking at need to be roughly 5.5 to 6% going in cap rate. So we do have there is a decent spread to the 10-year there, and thinking about the spread to 10-year though, we don't think about it kind of in isolation, because again, 3.5% cap rates extremely aggressive. But when you're talking about a well-located asset that has relatively newer construction at a going in 6%, 5.5% cap rate, that may not be 200 basis points over treasuries, but that feels pretty good from a long-term hold perspective and can generate even reasonable unlevered cash on cash if there is some value add component to it as well, which generally there is. So I think the old adage is a good rule of thumb, but not in complete isolation of some of the other factors that we like to think about.
I think it's a good time to talk about, what the Vanamor value add is. You've talked a little bit about it, but when you acquire a property, talk about generally what the opportunities are to improve either the profitability or the leasing cadence. You talked about mom and pops maybe not being as sophisticated, but what is the opportunity set that you believe that you can bring, that a potential investor should be really interested in?
Yeah, it's generally a combination of operational improvement, so reducing expenses plus revenue improvement as well, so bringing rents to market. So usually it's a combination of the two of those, and what we like to see and do are the there's a property that we're closing on right now, and it's a good example of, I think, a light value add strategy that we like to execute. So we're budgeting to spend roughly $7,000 a door on the interior and exterior. So exterior paint is one item. Some improvements on the exterior landscape is another item. Interiors, it's new kitchen cabinet fronts. It's replacing the flooring. It's plumbing and lighting fixtures. So those are all pretty basic and quick items to be able to execute, and to achieve a much improved aesthetic from those, which generally can capture a little bit of rent premium versus where in place is an ideal profile where you are effectively just doing a turn. So a turn versus a renovation. The turn is just when a person moves out and you bring someone else in. Maybe you're just doing paint and new carpet, and we're doing effectively just like one minor step above a turn. And that's not always the case with kind of properties that we acquire, but it's a good example of a lighter value add component that we think is an option out there. And some of the things on the expense side, I think, that are worth mentioning, especially when you're talking about smaller sub-institutional size properties. A lot of people will say, okay, I don't like this deal because it's it's less than 50 units, and you can't achieve economies of scale from a property management perspective on less than 50 units. And while I think that's a fair comment a lot of times, um, it's not completely true if you have a group of smaller properties within a submarket that you can ultimately use the properties together to kind of achieve those same economies of scale. So you have, 3 to 4 properties at 25 to 30 units each gets you over 100 units. And, what that can do is that can then afford a full-time leasing and maintenance person across those units. So you can kind of get to the same place if you have the right portfolio composition and kind of experience doing this piece, as well as some of the other things that we like to do that I'll highlight on kind of the technology side of things is the smaller assets with mom and pop owners a lot of times don't implement any technology improvements. And real estate in general is not at the forefront of technology these days either. But at Vanamor, just a couple things that we do are, we implement virtual tours at each of our units. So you can go online and do the virtual tour. You can also do a self-guided tour. So you can kind of go there yourself. You can get access to the unit and you can go inside. And I think that does two things. It's people like to do everything online that they can these days, which I get. And two, it also helps us from a staffing perspective because you don't need to have somebody there all the time to show someone a unit. And so ultimately can reduce our expenses and also improve the user experience as well with some of those things. So those are a couple of the things that we do. And on the AI is a big talking point and a big potential tech that's really changing a lot of areas, and we are looking to utilize some of that with kind of maintenance requests. So people can put in a maintenance request, and we can have the first line of defense be an AI chatbot that says, what is it that you need, and okay, then it directs it to the right place. So it's just a little bit more kind of on the efficiency improvement side that does flow through even to these smaller properties, and also again improves the experience of having somebody who's there answering phones and answering questions when you need somebody.
In addition to the technology side, you describe Vanamor as a data-driven company. You mentioned a couple of times that sometimes the mom and pops are maybe not charging market rents. Is that part of the maybe edge, is that you have a data set of rents and have a better sense of what the market is at than maybe some of the peers who don't use as much technology?
Yeah, we do. Because we're in the markets constantly underwriting deals. We have our own kind of underwritten expense comps. We have a good network of again kind of debt brokers that can help out on understanding expense comps. I think another good example is again on this property that we're looking to close on any day now. They had a very elevated water expense, and it was kind of overlooked by both the seller as well as the selling agent. Didn't really highlight that could be a potential expense savings point. And we own another property down the street that's operating at a sufficiently reduced water expense relative to that. So kind of really understanding the numbers and the data as far as what goes into the underwriting, I think is definitely something that we highlight and really rigorously go through when we're pursuing and underwriting deals.
This season of Compounders is sponsored by Delupa. Delupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Delupa offers an AI-driven single source for all company reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit delupa.com/compounders. And when a big insurance company owns a building, it typically outsources the management to someone like Jones or CBRE. I'm interested in how you manage a property as a principal, like Vanamor is, versus an agent, which is, the property manager who works for CBRE. What do you think the difference is, acting like an owner versus a kind of an agent?
Yeah, I think it's an important note. I think universally property management is tough. I mean, it's tough to find a great property management company, and it's a hard job to do. Not to discredit all the property management companies out there. It's a tough job to do. So you know, oversight of property management is kind of a key function. And what we are doing at Vanamor is we are very closely overseeing the local property management company that we have kind of doing the day-to-day blocking and tackling. And we don't have a multi-billion-dollar portfolio where we can't kind of keep a very close eye on what exactly is happening to your point. And I do think that's something like every single deal that we're going to acquire is extremely important to us and our investors. Ultimately, we're looking to kind of grow our portfolio and grow our investor base. And to grow our investor base, we need to deliver on the properties that we have acquired. And a big piece of that is making sure that we're efficiently managing and operating the property. So we have a very highly focused approach of making sure that property management is being handheld when needed, and the business plan is being executed to the projections.
So it really feels like, and I don't know the timing of this, but it certainly feels like the next 18 to 36 months at the very long end is going to be a pretty interesting time to put money to work. Whether that's an office or, multifam, or, the other areas where there might be some debt related distress coming around. What are you guys out there doing? Are you actively looking to raise a fund, or we talked about that as a potential long-term thing, or are you more looking for individual properties and looking to expand the number of potential investors who could participate in the syndication?
Yeah, we're not actively looking to raise a fund at some point again. I think that's in the future, but we are very actively looking to acquire more properties. And from a big picture perspective of opportunities that we're seeing, you're starting to see select opportunities, I think, that make sense. It's not this broad based kind of you can buy anything at this point in time, because um, there's still some of that. I think the time just needs to continue to move forward to ultimately put more pressure on the sellers. But what one of the things that you said really, I think, hits the nail on the head. You have the capital markets impact that we've seen here. And while I fully acknowledge I can't predict what's going to happen in the broader economy, what you haven't seen really is you haven't seen property fundamentals meaningfully deteriorate. So you've seen the impact from just the interest rate increase, and that flows through to the valuations perspective. But you haven't seen a huge drop off in vacancies, for example. So vacancy has ticked down closer to anywhere between 92% occupancy to 95. But it's well within kind of the historic norm. So you aren't seeing a huge impact of kind of macro economic downstream effects. So if you had a lot of job loss, for example, then you may start having increased vacancies and more strain on the property fundamentals. And ultimately, I think it could happen. Maybe it doesn't as well. Starting to look a lot more like a soft landing potential here in the economy than it looked like 3 months ago, at least. But you definitely have the potential where you could see kind of additional stress or pain on the market outside of just the capital markets impact. But I do think it's a very interesting time to be starting to deploy. Like, I think of it from a kind of just a portfolio allocation perspective. Dollar cost averaging into real estate at this point makes a lot of sense to me. I mean, we're anywhere between 15 and 35% off of peak valuations in late 2021, early 2022. And anytime you're buying a well-located hard asset, north of 25% off of where it was, I think that's not a bad starting point. Could you go down potentially further? Maybe so. But dollar cost averaging to me kind of into this space makes a lot of sense, and really for folks to kind of start paying attention. I think the other really interesting dynamic that's happening right now is again, like I mentioned, we're well off of peak valuations on the multifamily side and just commercial real estate in general. Then you kind of juxtapose that to what's happening in the public equity markets. I mean, public equity markets are effectively at all-time highs. So, you have this huge gap between what public equity markets are doing versus private real estate. And, at some point, I think you're going to get a convergence. Is it real estate goes back up to the public equities, or public equities kind of moves back down? A little bit uncertain, but again, I think paying attention to this space now that we've finally really seen a downward move from where the valuations were, I think makes a lot of sense, and could be very interesting from a portfolio allocation into a very tax efficient long-term asset.
And you mentioned tax efficiency. I think you are the first private real estate investor we've ever talked to. Would you remind our listeners, if an investor is an individual or family office who's tax conscious, what are the benefits of owning real estate from a tax perspective?
Yeah, I think it's one of the biggest benefits of the asset class is you, by investing in it, you effectively are an equity owner in the real estate, and therefore you get kind of pass through revenue and expenses from the property. One of the largest expenses on a property is depreciation expense. So a lot of times what happens when you purchase a property is you have your revenue, you have your expenses, and your depreciation expense ultimately takes your taxable liability down very low for what you actually have to pay taxes on. So while you may be receiving cash flow, like actual cash flow into your bank account on a quarterly or annual basis, you're very likely going to be able to defer the bulk of that taxes because of some of these depreciation and other expenses that flow through. You can defer them 2, 3, 4, 5 years out until there's a capital event at the end of the deal. And there's also very favorable bonus depreciation that's still in play right now. It's phasing out over the coming years, but what that does is it lets you take an even larger chunk of depreciation expense year one that you can utilize to reduce taxable liability on your rental income. And it ultimately just is a very powerful tool for deferring taxes and down to when you ultimately have, again, a capital transaction. And then when there is, an actual sale, I think perfect and very fitting to the Compounders podcast here is, you can still 1031 exchange at the end of that period. So let's say we own an asset that we've approved on it, and the valuation has improved over the years, and then we look to sell it in year 5. We can then defer the capital gain further by buying or exchanging into a new asset using a 1031 exchange ability, and then that defers the gain again. So you can then effectively roll and compound your basis tax free, more or less, another 5-10 years, however long you hold that property. And you can kind of continuously do this over the years, and that's really what a lot of folks and groups and have done to really compound gains in real estate over the years and have a very kind of tax efficient profile in doing it.
Yeah, I mean, it is a gift. The gift of the tax code is flows down to the private real estate investor. And so you've been through a number of real estate cycles. You lived through the great financial crisis. You watched COVID and that impact on all the asset classes. And now we're in a post-COVID interest rate rising period. What are some of the lessons you've learned about real estate investing as a result of those experiences?
Yeah, it's there's been a lot of ups and downs that I've seen in my career, and I think the first and foremost way that we like to think about is we want to make sure that we don't lose money. Um, and with real estate, I take an approach that successful investors can build wealth in a tax efficient manner over a long investor horizon. But with that in mind, the number one goal again is to make sure not to lose money on deals. So really having a good understanding of risk adjusted returns as well as downside protection is critical and something I don't take for granted, having lived through the great financial crisis and some of these other markets. And I think that's probably my biggest takeaway is understanding and appreciating risk adjusted return and thinking about that. I think the 3.5 cap rate environment is a good example of your ability for cap rates to go down even further is very low at that point. And I think it's underappreciated how impactful the valuation move can be from a widening of cap rates from that historically tight level. So um, there's that's strikes me as the biggest takeaway.
And if we're having this conversation in 7 years from now, what do you think? How would you define success at Vanamor?
I think I think uh, success to me looks like when we have a lot of very satisfied and happy investors that will say that they've earned an above market return and have always been able to sleep well at night and really appreciate the quality of information and team availability they receive. So, I have a long background of investor relations as well, and we really pride ourselves on having an investor mindset and creating proper incentive alignment structures. So, if we can build and operate the portfolio in a way that creates what I just referenced, I think the growth goals that would define success that we discuss kind of at Vanamore will work themselves out. So I think that's probably one of the biggest. I think also, again, I referenced it before, but having both the fund model and the syndication model, I think is also a big piece of success 7 years from now, because I think again there's definitely pros and cons of both of those.
And I want to sneak in one more question about multifamily as an asset class. As I've been doing some work in the real estate space, one of the complaints we've consistently heard about in the office space is the capital intensity there. You've got to spend millions or hundreds of thousands of dollars on lobbies and common areas and gyms, in addition to like a lot of work when a tenant moves out. How would you say multifam compares in that capital intensity to some of the other real estate asset classes? I assume that's one of the reasons why you think it's attractive, relative to others, but maybe that's just a guess.
No, yeah, I think that's again a fair point. Yeah, you don't have the TI, the tenant improvement aspect of that on all multifamily assets. You do, there we will be underwriting and likely to be acquiring deals that have communal space in them, be it a pool or a gym or kind of a common area. But it's generally, I think, it's going to be less capital intensive than some of those big office projects, and it's also, um, you know, I think it's going to be a little bit smoother profile as well. Like you don't have this one tenant that can ultimately leave and you have to spend this $2 million to get a new tenant in there. You've got a much more diversified with respect to kind of the number of tenants in a building, that helps create a smoother profile both from the revenue and the expense side. So I think it is a fair comment to say that the capital expenditure piece is a little bit more favorable relative to some of the other asset classes.
Evan, this has been a great conversation about multifamily real estate and the opportunities and how cap rate moves have impacted the asset class. So we'll close with what the question we always ask is, what do you think is the most underappreciated aspect of the investment opportunity in front of Vanamor right now?
Yeah, I think the appreciation of how much valuations have come down from peak pricing already, I think is the most underappreciated. And we just talked about it, but really that the size of that drawdown for people who aren't in the space, they just don't realize it because a lot of people's perspective on real estate is the home that they own. So the single family side, the single family side hasn't really missed a beat. You could even argue that in a lot of markets it's still going up, even when you have mortgage rates at 7 to 8%. So a lot of people don't really appreciate the magnitude that some of these properties are down from where they were. So again, I think what does that mean? I think that it means that it's a good time for people to start paying attention to the space if they haven't before, but they are interested. A lot of people have been waiting for this drawdown, and not everyone realizes that there's been a good amount already. So I think that is the most underappreciated aspect of the opportunity.
Well, Evan, I think you have it's an interesting starting point, and it seems like it's going to be a compelling time to put money to work in the multifam space. So good luck with that. We really appreciate you being on Compounders.
Thanks, Ben. Really enjoyed being here.